So index-based insurance comes with a set of reasonably well-known challenges, and these are well documented in the IAIS and A2AI material that I mentioned, but I just wanted to outline them here so that it helps you to get an understanding. First one is basis risk. Basis risk is talked about when it comes to index-based insurance almost entirely, and even though it's relevant to other areas of insurance, it's a particular issue here. That's where the insurance policy itself triggers based on the index to pay a claim, and yet the actual losses incurred by the insured person who's seeking to take out the insurance to protect themselves against those losses are different. Now, in the case of index-based insurance, it's best illustrated by thinking about two sorts of conditions. One of them is the bad thing happens. The second thing is that the index triggers. So if you imagine a situation where the bad thing happens, the index triggers and a claim is paid, that's fine. If you imagine a situation where the bad thing doesn't happen, the index doesn't trigger, that's fine too. But what if the bad thing happens and the index doesn't trigger? That's where the customer suffers a loss, but the insurance doesn't pay. This is called adverse basis risk, and it affects customers very adversely and is very undesirable, creating big problems for index-based insurance projects. The second possibility, however, is when the bad thing doesn't happen, but the index triggers, in which case the customer gets a payout even though nothing happened to them. That's called perverse basis risk. It's a little abnormal, but it's not going to put the customer in such an adverse situation. But nevertheless, it means that claims are paid when they didn't have to be, and the cost of insurance is going to be higher for everyone. So companies try to develop their index to avoid these kinds of basis risk problems. Second issue is the question of understanding on the part of the clients. If clients have had some experience with insurance, even in very, very broad terms they've heard about it, then having a situation where bad things happen but they don't get paid, for example, is particularly problematic. And it could be basis risk, or it could simply be that the trigger point is triggered higher up on the adversity scale than people had understood. So in this case, people think if you have a flood that damages your crop, we're going to pay you. If in reality we meant if it rains more than a certain amount for a certain number of days, then the trigger may well be further away. We might have, or should properly have said, really bad floods rather than just a day of rain. And so we have to be very clear about that. And there's plenty of cases where this kind of lack of clarity has actually led to customers thinking they were entitled to a claim when they weren't. These situations, which we could describe as just understanding problems and disclosure and explanation problems, are often described as basis risk problems because it's so popular, when in reality they're nothing to do with basis risk. They're simply to do with bad communication. So that's a big challenge. Third challenge is the credibility of the index. The IAIS paper sets out some criteria for what a credible index would be. But there have been situations where the index itself seems fine, but when adverse events happen, nobody can find the calculation, or it doesn't work so well, or something like that, or the customers find it difficult to understand. There is, for example, a process where satellite imagery is used to consider the level of drought because of the amount of vegetation on the ground and the colour of that vegetation in particular. Now, that might be difficult to explain to your average farmer who sees what's happening on the ground and has a closer view about it than to suggest that they should be relying on the readings of some satellite which they can't see. Another issue with index-based insurance is the question of micro, meso, or macro. That is where who is the policyholder? Macro schemes tend to be provided to governments and often have to do with disaster recovery and big natural disasters, and the government is the insured party and gets the money and then spends it on providing restoration services and such as necessary. MISO schemes do something similar for subnational, either regional governments or private institutions, banks, any kind of organisation that might be in a situation where adversity strikes. They get the money and they can do something about it. And sometimes they can do something for the benefit of quite small, low-income customers, like provide restructures of loans or some kind of grant arrangement or something. But one thing they shouldn't do, according to the IAIS rules, is tell people that they've taken out insurance for them that will pay a certain amount in certain situations, because that's a micro scheme. Micro schemes are where the individual insurance is attached to the individual person, whether they bought it as part of a group arrangement or an individual thing. If they have an individual policy, an individual benefit, then it's a micro scheme for individuals. Now, why that's important is because when it comes to adverse basis risk, for example, or the credibility of the index or the understanding of the customer, all of those things are going to differ depending on whether you're dealing with micro customers, meso customers, or macro customers, and therefore the regulation that you have could be different. The next thing is the question of definitions of insurance products. That's a big issue in terms of what should be in the law, and some people have legal definitions which are indemnity product based. So the idea that someone might get a payout that is higher than their loss, such as perverse basis risk, may not fit that definition very well. And then there's a question of whether it's treated as an insurance product under the law. The IAIS has again said about that it should be treated and supervised as insurance, and the law should be amended if necessary to accommodate that. And there's different ways that can be done, which we can talk about if you've got some questions. And finally, there's the question of pilots and other experimental approaches, regulatory sandboxes, things like that. These are quite important in index-based insurance, particularly in agriculture and climate-related situations, because there's a lot of experimentation takes place, but the experimentation can take quite a long time, because instead of doing an experiment and then making some adjustments and then doing a further one to see if that was sufficient, you have to wait until the next cropping season or the next hurricane season or the next whatever season. It could be a year away before you can have a second attempt, and therefore it can take several years for these projects to come to fruition. And as supervisors, we have to have experimental approaches which can accommodate that and take account of the long lead times that are involved in these kinds of projects. So there's a whole lot of issues related to index-based insurance. There are other comments in this course, particularly around the climate modules and such, where these kind of things do get discussed again.